Good afternoon, traders and investors. Will back here with another one, coming to you with a weekly market recap. Hopefully all you guys are doing well and wishing you all a very happy start to the holiday season too. Now, of course, last time we saw each other was after the Wednesday flash crash / liquidation event that was brought forth by a change in tone from Jerome Powell. Prior, Jerome Powell had been having a very confident tone in terms of the direction of the economy, the direction of the jobs market, and the direction of overall inflation. And now the tone has pivoted to one of more uncertainty. And we did see that in terms of the interest rate projections by the Fed as well. So a lot to cover in today's video, guys. Number one, we're going to be recapping the events of last week. What exactly happened? How do they relate to the bear market thesis? And can we possibly be seeing a little bit more volatility in the near-term future? Number two, we're going to be going through one company earnings from last week. That is going to be Nike, that had their earnings Thursday after the close. I will be doing Micron, but only on the Monday session after the close. Did not forget about you guys. After the Nike earnings, we'll be taking a look at our technical analysis on our major market indexes. How is the market breadth right now? Have we recovered, or is there possibly still some red flags at play? Thereafter, we're going to go through our big tech names, see the technical analysis there too, and whether or not there are some good buying opportunities and some of the strongest names in the market. And to wrap it all off, we will take a look at the trades made by myself over the course of this week and which positions I am keeping into the foreseeable future. So a lot to cover in today's video, guys. Let us jump right into the action, shall we? So SPY on the Friday session up about 0.86, QQQ was up 0.87, and you can see from this watch list right here, very nice broad market bounce into the Friday session. Take a look at the heat map and you will see a very stark contrast from the Wednesday session. A lot of this was due to favorable PCE inflation numbers that came in on the Friday session, and we'll take a look at that in just a few short moments. But overall, very nice broad market recovery. I wouldn't say that the market is truly recovered, especially not after only one day of bounce, but suffice to say, the bulls really did need this. However, if we put it on a 1 week relative, guys, you will see the damage has still been done, and even on a 1 month relative, you will see still a very top heavy market. So the bottom half of the market getting a nice bounce on the Friday session, but still a lot of work to do in that aspect. Now, into the 1 day, you will see that every single major sector in the stock market was green, but still on the 1 week relative, and as we saw on the 1 month relative, a lot of pain has been felt in the markets over the course of the month of December, which is traditionally a bullish month for the markets, but maybe not this time. The month is not over just yet, but still a lot of pain in the markets, and I wouldn't say that the pain is necessarily all behind us just yet. So before we jump into more technical analysis, I want to go over a few key points before getting into the Monday session, right? So a few key points that we have to go over is number one, the Friday PCE numbers. So we know that Jerome Powell instilled a little bit of uncertainty into us in terms of the expectations for inflation and the direction of interest rates moving forward. Take a look at this, guys. This is the summary of economic projections that the Fed released last Wednesday, of course, and this is the reason, or the reasons plural, for some of the sell-offs that you had. Change in real GDP, that one was the same in terms of the median expectation for 25 and 26. You can see that the December meeting coming in at 2.1 for next year and 2.0 for 2026. Not much of a change. As a matter of fact, a little bit of an uptick from September. So the direction of the economy, still some confidence there. But thereafter, this is kind of where it starts unraveling a little bit. The unemployment rate was still fine, as we can see from the median projections right here. However, he did note that there were many factors starting to affect the direction of the labor market. So what Jerome Powell was saying was different from what we were seeing in the median projections right here, which is where the whole uncertainty comes into play in terms of the labor market, right? So Jerome Powell noting several factors in terms of the deterioration of the labor market. However, they did not pencil that into their projections just yet. So once again, leaving the market somewhat confused and somewhat uncertain. And one thing the market does not like, guys, which I keep telling you, the market does not like uncertainty. So when Jerome Powell is saying something that is different from the projections, that is what causes a little bit of the sell-off. Now, this as well was a very big pain point right here, which is the PCE inflation. Take a look at the September projection for next year. It was about 2.1%. Now they've hiked it all the way up to 2.5. Now, that is not so much the problem as to the reasoning behind the penciled in upticks by the Federal Reserve members. A lot of the reasons for them was being a little bit too political for people's liking. The Federal Reserve is supposed to stay very separate from any administration whatsoever. And Jerome Powell had noted in the conference that if a lot of the Fed members had started penciling in higher inflation than expected because of the potential new coming administration, the Trump administration, and their possible policies on foreign tariffs. Now, the Federal Reserve is never supposed to do that, guys. They're supposed to stay completely objective and say whatever happens, we have the tools in order to combat that. They are not supposed to take in consideration an administration's policies to project in terms of what they're supposed to expect in the market. They are supposed to react. They are not supposed to give commentary by the numbers right here in terms of political stance. They definitely did not do it at all during the Biden administration, when the Biden administration was facing very high levels of inflation and also putting forth several policies such as the Green New Deal, such as the Infrastructure Act, such as the many semiconductor acts that they were giving. So the Federal Reserve did not react to the previous administration's policies, but they felt the need to react to the incoming administration's policies, even though those policies still are not set in stone. That rubbed the market a very wrong way, which is another reason why you had a tremendous amount of decline on the Wednesday session. And the kicker is, of course, in the change in the federal funds rate. Federal funds rate, the projections from September for next year were to be 3.4%. For the final rate. That would have been an additional 4 interest rate cuts over the next year. Now they're sitting at 3.9, which is only 2 interest rate cuts over the next year. And even in 2026, guys, it used to be 2.9 and now up to 3.4. And even the longer run, also known as your neutral rate, was uptick from 2.9 to 3.1. In other words, rates higher for longer. Why? Because they feel that inflation may come back and be a little bit of a problem. So all of these things combined led to a lot of uncertainty in the markets and led to a big sell-off. A Fed that was previously very confident in the stance of the economy, in the stance of the jobs market, in the stance of the direction of inflation, now sowing some uncertainty into traders and investors' mind, and everybody reacted in the way that they should have. They pretty much sold off the markets, and Wall Street went on an absolute frenzy, complete liquidation event, flash crash, forcing liquidations, forcing closes on everybody who has been over-leveraged so far. All they need is a slight little pretext. All they need is to smell blood in the water, and they will definitely go hunting for those stop losses. So that is a quick little recap of last week, and which we've noted into a narrative shift from the Federal Reserve. I bring up this bear market thesis, right, that I've been over a few times so far. But if you didn't see the Wednesday video, we were noting that all of these elements right here, these are the elements of the bear market thesis. And what Jerome Powell did is he gave credence to a lot of these factors. Unemployment will skyrocket. He didn't help that one. The Federal Reserve is too late. The damage is done. He didn't help that one as well. A lot of people were criticizing the interest rate cut. They were saying, well, if you expect more inflation, why are you cutting rates? So the Fed is late, double late in this respect. They were possibly late in raising rates and now possibly either late or too early in bringing them down. So basically, just the damage is done. The Federal Reserve is unfortunately either lagging or leading too much at this current time. They're trying to be too proactive and not being reactive enough. Didn't help that one. The data is fake. CPI, jobs, and economic output. They definitely did not help that one either. The incoming Trump administration and uncertainty around those. Tariffs, economic mismanagement leading to inflation will come back. Definitely did not help out that one. They're not even supposed to talk about that one, but this one was a pain point in the market. The market is overvalued. Well, you saw what Wall Street did, right? When things are overvalued and the P/E ratios are running high, they can drop the markets in an instant, and people will have no problem justifying that was due to high valuations and into uncertainty as well. Buffett in cash, that has been the case for a few quarters right now. The U.S. debt ceiling crisis, that is front and center in everybody's minds. Consumers are over-leveraged on credit. We didn't see that one too much. We went over the bank earnings, Visa and MasterCard and American Express. That was not the case. Commercial real estate crisis, not the case either, but if the 10 and 20-year yields continue being high, this one could become real over the course of the next 6 to 12 months. The rest of the world in the recession, that is very true, guys. You notice that by the influx of sheer money into the US dollar as of recently. Look at the move on the dollar in the last roughly couple of months. Just goes to show the only bright spot in the world right now is the US market. So you have people flooding into the dollar, flooding into US assets to kind of get some gains wherever they can possibly find them. And for now, that is really the US market as a whole. The AI tech bubble, right? Jerome Powell didn't necessarily help or hurt that one, but we know when there is talks of being in an AI/tech bubble and you get some uncertainty by the Fed, well, it can lead stocks to pull back very, very, very quickly when you already have some doubts in terms of that. Yield curve uninverted, the SOM rule as well, those are still in play. Manufacturing output is weak. That was also a case in point, led by the Monday read, which you got a 48.3 on the S&P Global Manufacturing PMI in relation to the 49.4 expectation. These manufacturing reads have been very weak for a while now, so last week's definitely did not help. Then anecdotal experience, my friends are broke. A lot of people say that, but some people are not, so I'll kind of leave this one open to interpretation. And then the indicators, right? The VIX absolutely skyrocketing. The low put to call ratio that we saw leading into the Wednesday session, nobody had puts, nobody had protection. And since then, you saw the rally in the VIX. Everybody wanted to buy insurance when the house was on fire. And smart and dumb money, we are going to take a look at that, guys, when we go over the SPY, right? In just a few short minutes after the Nike earnings recap, we will go into the smart versus dumb money and see, are the institutions starting to bid after the flash crash / liquidation that we got over the course of the last week? So as you can see, all of the doubt from Jerome Powell's speech and also the revisions to the economic projections, those all led to a lot of the catalysts for the bear market thesis / crash / recession all coming alive, right? So that is a reason that the markets dropped so hard over the course of last week. I wouldn't say that all of these can be solved in 1 or 2 trading days. It's going to require a lot of clarity from the Federal Reserve in the January meeting, which is January 29th, and also a lot of clarity from the incoming administration from Trump and his policy members as well in terms of what they plan to do with tariffs, especially tariffs, and how other countries may respond. So we cannot solve this uncertainty, guys, in just a few short days or maybe even a few short weeks. In my opinion, we will only be able to get a lot of that clarity leading into the end of the month of January into the early stages of February as well, which, case in point, is also Q1 earnings for companies. They will give their direction in terms of where they think the economy is going, if they're laying off people, if their margins are being compressed. All of those things will lead to the guidance and outlook for 2025, plus the Federal Reserve, plus Trump coming into office. So it could be a very volatile market environment, at least until the end of the month of January. I'm not saying that the market's going to go straight down, but can we see some whipsaw effects like we've been getting in the past week, where we have very violent move down, very violent moves ups, and then more violence in between? Absolutely, guys. So get ready for that volatility, because I think at least over the course of the next 1 month, it is definitely here to stay. So that is a quick little intro and weekly recap of what happened last week and what to maybe expect over the next 1 month of trading. Now let's get into something a little bit different, which is going to be the Nike earnings. So Nike coming in with earnings Thursday after the market close, and you can see they really did a whole lot of nothing. They had a very nice pop in the after hours. Let me just turn on the extended trading hours here. Very nice pop, a drop, and then pretty much back to where they closed. So this had to do with a number of things, guys, but you all know that Nike currently right now in a big recovery story. Now, usually I give the context surrounding what exactly happened to this brand, but when we cover the article, you will see that it does a pretty good job of summing it up. Essentially, to say the least, Nike has lost its way. Lack of innovation, buildup in inventory, stale products currently have led to people just being disinterested in the brand overall. And now that we have a new change in CEO and finally the company acknowledging that they have an execution problem right now, we are looking for signs that Nike may be looking to turn things around and looking for steps and solutions as to how they want to do that. So let us dive into the earnings right away, shall we? So the numbers at a first glance were not bad, but then again, the expectation was very, very low. They sandbagged the guidance now for 2-3 quarters in a row. They said it was going to be bad, and it came in slightly better than the expectations, but overall, they weren't very good. The numbers beat, though, 16% beat on EPS and a 1% beat on revenue, but it was on lower and lower guidance, right? So looking into the article, shall we? So moving on, Nike CEO Elliott Hill outlines new strategy after retailer blames promotions for declining revenue and profit. So let's dive into this recovery story, shall we? Nike's turnaround will take a bit longer than expected under the new CEO, Elliott Hill. And I've been saying this for a while, guys. These recovery stories, whether it's Intel, whether it's Disney, whether it's Nike, whether it's Starbucks, or so many other companies, guys, You cannot just snap your fingers and expect these companies to turn around instantly. It takes several quarters, if not, dare I say, several years sometimes. Let's move on further, shall we? The sneaker giant has been relying on promotions to drive sales, and it plans to return its online business to a full price model. But first, it will need to aggressively liquidate old inventory through less profitable channels, said the CEO. Now, Nike has been having an inventory problem for the last 2 years. They just cannot get rid of all of their stale models that nobody seems to want. So now they will have to do aggressive price cuts. They've already been doing very aggressive price cuts, but now they literally have to floor these items. Now, from what I've seen, is traffic in Nike Direct, digital and physical, has softened because we lack newness in product and we're not delivering inspiring stories, said the CEO. So he acknowledges what are the current problems at hand right now. The result is we've become far too promotional. Entering the year, our digital platforms were delivering roughly a 50-50 split of full price versus promotional sales. The level of markdowns not only impacts our brand, but it also disrupts the overall marketplace and the profitability of our partners. This is true, guys, right? If you're a company like Louis Vuitton, you almost never see Louis Vuitton products on sale. The same thing for Apple. When do you guys ever see Apple products on sale other than maybe Black Friday or Christmas events? When your products are always on sale, it dilutes the kind of prestige version of your brand, right? So, as a result, Nike expects gross margins to be down between 3 and 3.5 percentage points during the holiday quarter, another quarter of declining profit margins for Nike. It also expects sales to be down low double digits, so another event of quarterly declines for that. Net income reported was $1.16 billion. That is 9.3% in net margins. Where do we stand in terms of historical margins? Well, you can see, guys, gross margins have been hovering. They've been able to protect them. But look at these operating margins. This is the result of continued discounts and promotional events, which is just eroding your operating margins as they spend more and more money on marketing, more and more money on promotions. And as a whole, it has resulted in some weaker net margins too, a far cry from the net margins we had in 2021. Now they're already down to the 9.6% range. And I'll remind you guys, in terms of where this company has been heading, it has not been good. Look at this decline in EPS over the last 4 years. Big declines. And for the last several quarters in a row, declining EPS, and revenue is just the same. Revenue has not moved, guys, since 2020. 2019 arguably has been consistently declining now for roughly the past 6-7 quarters. It is not very good. So if you're wondering why the stock price is exactly the same as it was during 2018, well, this is going to be a masterclass on why EPS matters so much. Look at the EPS number for 2024. 2.23. The last time they had those numbers arguably was 2019 or 2018. So no secret that Nike is trading exactly at the same level. They cannot increase earnings per share, so their share price is trading exactly where it was 6, 7, 8 years ago at this time. Let's move on further, shall we? So sales fell down 8% from a year ago. Definitely not good, is it? But the declines continue thereafter. After it fell behind on innovation, ceded market share to competitors, and botched its selling strategy. All facts are true, guys. You can't blame it on the consumer, guys. Can't blame it on consumer discretionary spending more than that, right? Take a look at Nike's competitors. ON, absolutely flying. Decker's outdoor brands, absolutely flying. Even a company like Skechers, doing a lot better than Nike is currently, right? So it's not the consumer's fault. It is the company's execution problem. I have an irrational love for this company, said the CEO. I know Nike inside and out, take pride in what the brand stands for, and want to see the company succeed. Far different message from the prior CEO, right, who seemed to be a little bit distant from the company as a whole. In a moment where our team, brand, and business are being challenged, my singular focus is to help us get back on track, to get back to winning. So it seems like he wants to. He's a veteran of the game, guys. He's been at the company since the 1980s, essentially. During his opening remarks, Hill delivered a resounding rebuke of the strategies that have come to define his predecessor, John Donahoe's tenure as CEO. He said the company had spent too much of its resources focused on driving online sales, paying for performance marketing, and isolating wholesale partners, strategies that he now plans to unwind. Very briefly, guys, I'll explain to you what happened. During the prior CEO's tenure, what they were doing is they were focusing only on online sales. They kept trying to drop new releases of the same brands over and over and over, namely the Air Jordan brands, and a lot of the other brands like the Air Force Ones and stuff like that. They lost their way. They lost their focus on focusing on building out good shoes for actual athletes, right? Good running shoes, good basketball shoes, good soccer shoes, etc., etc. And they were focused more on the designs and the styles of some of their legacy brands. Number two problem is they cut a lot of ties with their wholesalers like Foot Locker and other companies like that. And that is a lot of shelf space, right? When you walk into a Foot Locker, Nike used to have a tremendous amount of wall space. And since the past 2-3 years, they've now cut down on their exposure to those wholesalers. And who now is filling those gaps? Well, Nike's competitors, guys. So not a good look at all. So these strategies, the current CEO is starting to unwind. We will win when our partners win, talking about how they unwound some partnerships with the wholesalers and now they want to get them back. That's good news for the partners like Foot Locker, JD Sports, and Dick's Sporting Goods. The CEO, also called out a criticism that has swirled around Nike for the last couple of years. The company has lost sight of what had long defined the brand: athletes and performance, leading it to cede market share to competitors such as ASICS, On Running, and Hoka. We lost our obsession with sport. The reliance on a handful of sportwear silhouettes is not who we are. Talking about those Dunks, Air Force Jordan 1s, and the Air Forces, right? Now, Nike made so many of these shoes that they became commonplace and uncool. Flooded the market, guys. Too many reskins of the same shoe. Nike is trying to cut back supply, which it has said will impact sales in the short term, but hopefully not in the long term. Now, sneaker sales. Listen to these numbers, guys. They were a disaster. Sales at Nike store and online were down 13%. Wholesale revenues were down 3% year over year. Inventories were higher than the company wants them to be, especially given the recent sales trends. Nike saw sales down in all 4 of its geographies. Results were better than expected in all regions except for China. So they were down, but better than the expected results because they already gave such weak guidance. Now, North America, sales declines 8% year over year. Europe, Middle East, and Africa, down 7%. Asia, Latin America, 3% down as well. Converse, again, down 17%, guys. So there's a big execution problem here at Nike, but at least we're confident in seeing that the new CEO recognizes the challenges that Nike is facing right now. Hasn't really given, he has given a few solutions. They want to get back to the partnerships with wholesalers and stuff like that, but we need some concrete numbers to go off of moving forward, which is why I still think, guys, it's going to be a heck of a long time for this recovery story for Nike. I do believe that they'll be able to manage it, but it might take some years to come, guys. Here's the problem here. $8 billion in inventory. That is just unacceptable, guys. For a company that makes $50 billion in revenue a year, for you to be constantly sitting, they've had $8 to $10 billion in inventory for the past 2 years. Historically, Nike has averaged a running inventory basis on a recurring basis of about $2 to $3 billion. They are sitting 2.5 to 3 times the amount of inventory that they usually sit on. That is a lot of money that is just sitting there in a warehouse that nobody wants. That is $8 billion in inventory. And when you make $50 billion a year, guys, that's a lot. That is a lot of money that you could be spending elsewhere, right? It's like 1/5, 1/6 of your possible revenue just sitting, collecting dust in warehouses, and you just have to further reduce and liquidate that inventory, which is, once again, not a good look for the brand at all. So where does the brand stand as a whole, guys? Where does the stock price stand amidst this recovery story? Well, let's have a look, shall we? So we already took a look at what the problem was, right? EPS, which is why I always focus on companies that have consistent increasing EPS curves, because when it's inconsistent like this, you see what happens to the share price. Revenues as well, largely flat for what? The past 5-6 years, and they will be flat. They will not be able to surpass truly the revenues achieved in 2022 and 2023, possibly all the way through 2027. So it is going to take a long time for Nike's recovery story to play out. That is for sure. In terms of the financials, well, we already talked about the margins getting squeezed right now because of all those promotions and all that marketing. And as you can see, free cash flow in the last 3 quarters has been a far cry of what it has been in the last few years. Nike is usually very good with free cash flow, but in the last few quarters, they have been suffering, guys. Those promotions, those marketing incentives, reworking inventory, reworking deals with suppliers and wholesalers, it has come to weigh on their margins and their free cash flows. Where do we stand in terms of valuation? At $74, 60% off the all-time highs. You may think that this company is trading at a steal right now. Well, unfortunately, I hate to be the bearer of bad news. Not quite. The PEG ratio is sitting at a 1.57. Forward PE is a 28. Not very crushed, is it? This is really historical averages for Nike right now. Just goes to show you the importance of EPS. PEG ratio down to 1.57, which is okay, but it's not a thundering steal, which would be under a 1, right? Free cash flow yield, I'll give it to them, trailing 12 months is 6.3%, but can they maintain that free cash flow over the next year as they renegotiate partnerships with wholesalers, continue to liquidate inventories, and pay a lot more for promotions and marketing? That is to be seen. This is, however, the highlight of the company being in a very good position for the free cash flow yield. They still have $7 billion of buybacks remaining, which is about 6% of the float. So the valuation right now, guys, is just that. It is okay. It's nothing special. It's not cheap. It's not expensive. It is just okay. That being said, the company is coming into a very large area of technical support. They have kind of been ebb and flowing in for roughly the past 5-6 months at this point in time. And that is all this location from back here, 2018 and 2019. So my stance on the company, guys, if we want to bid for the recovery story of Nike, now is possibly the time to do it. When the brand sentiment is at the absolute bottom, when analyst expectations are at the absolute bottom, and people don't think that they can do it, now is arguably the time to possibly be nibbling on Nike if it's a company that you believe in for the long-term next 5 to 10 years, but you have to extend your recovery story timeline maybe further than you're thinking. It's not going to happen in the next 3 months. It's not going to happen in the next 6 months. For them to truly get back to where they were, it's probably going to be looking like a 12 to 24-month recovery period. Same thing for Starbucks, same thing for Intel, same thing for Disney, same thing for so many other companies that are undergoing an execution problem right now and who are trying to get back to the basics of what made their brand once great. So now, decent little area to nibble. I wouldn't be opposed to even playing, some short puts, the wheel strategy down here and whatnot, but just don't be surprised if the price remains sticky down here for a while. We can expect some recovery eventually, but like I said, it's probably not going to be this, guys. It's probably going to be a slow grind higher, similar to what we've seen from the likes of Disney recently. It's going to be a very volatile and bumpy path, but the recovery can happen. It'll just take a lot of time moving forward. So that is everything that I had to share with you guys on Nike. Hopefully you guys appreciated that. Now let's dive into the juicy stuff, shall we? And that is, of course, going to be the technical analysis portion of the video. So number one, starting off with the S&P 500, guys. 0.86% to the upside. Now, before we get into the actual SPY, I want to be going over a few of the factors because we know that the market breadth has been a problem for the index as a whole. As you can see, the relative S&P 500, the equal weight, right? I always call it relative because of the RSP, but this is essentially the equal weight S&P. If you were to put all of these companies on the same weight, well, this is the index that you get. You can see this has fallen off an absolute cliff with the rest of your value names because there's been a lot more names that have been selling off than names that have been advancing, also known as advance versus declining names. And when you have a heat map on the last 1 month that looks like this, where the whole market is down except for a handful of names, this chart should be no surprise. Value names having one of their worst stretch in 20-30 years. The Dow Jones, same thing, one of the worst stretches since the 1970s. And even some of the value-based ETFs, like the Schwab Dividend Index ETF, has also been having one of the worst stretches in its history as well. So now we're starting to see a little bit of a bounce, a little bit more market breadth coming in as of the Friday session. Now, where do we stand in terms of market breadth? Well, here's the percentage of stocks above the 50-day moving average. You see, we've pulled down into 33%. This is a very low read. Only 33% of all stocks in the market right now are above their 50-day moving average. The RSI on this indicator right here is extremely overblown. The last time we saw this was in August during the flash crash / the unwinding of the Japanese carry trade. Prior to that was April with some inflation concerns. And prior to that, you'd have to go all the way back to the depths of fall of 2023 when we also had those inflation concerns. Traditionally, when we look at this on a longer duration basis, when we pull down into the 33 down to the 20, it is a decent area to start to go shopping. But as you can see, 33 is not the bottom. It can go lower, and it has gone lower a number of times in the history of this chart. As you can see, 33 starts to be an area where we want to start to buy, but not go all in. We can start dipping, buying more as this one keeps on dipping. But it's nice to see we have a little bit of a bounce in market breadth, but I would not say the bulls are out of the woods just yet. Percentage of stocks above their 200-day moving average, which is a longer duration metric as well. You can see we're tapping into the lows of the year. Only 52% of all stocks are above their 200-day. You can see we hit that last in September, in August, in April, and the last time is this April right here. And the last time it got really bad, you can see, guys, was October of 2023. So are we low? Yes, but can this one move a lot lower? Indeed, it absolutely can. So is it a good buying idea to be buying in these current market environments? Yes, but we have to be pacing ourselves, guys. We have to be buying slowly but surely and focusing on only the most high quality companies in the market that are not affected by these short-term narratives. Companies with very high free cash flows, companies with very high net margins, which is why I continue to be focused all or mostly on big tech, because the rest of the market is still underperforming right now. Now, another indicator that we like to look at here, guys, sometimes when markets get really, when the breadth gets challenged a lot, is the smart money versus dumb money. So what is retail and what are the institutions doing? Well, the dumb money right here, also known as retail, as you saw last week, was a wall of selling. Waterfall drop by retail. Institutions have not been buying this market. They have been unconvinced in this market, arguably since the month of October. Retail has been carrying this one a lot. Institutions have been selling into retail almost this entire time. But now, after having spent a lot of months here at the lows, several weeks at a time, to a level where when institutions usually get down here, guys, they tend to start buying. And now they have started buying and accelerating that buying after the dip. And now retail is panic selling. And who are they panic selling into? They are panic selling into the institutions. So the institutions are starting to buy the dips right now, but they as well are going to be doing the same thing that I was talking about. They will be buying slowly, guys. As retail continues to be uncertain, as the volatility continues to pressure the markets, institutions should be continuously bidding right here, but do not expect probably a massive bid by institutions. It must be a slow moving thing, right? It'll take some time, but they will be buying the dips if retail keeps panic selling the bags. This is what I like to see, guys. When retail is panicking, when there's a lot of fear, a lot of uncertainty in the markets right now, you want to see the big money step in, and they are stepping in a meaningful fashion right now. We're not saying that the markets cannot go lower, but at least we're starting to see some institutional support. So that is a very good sign. So when we recap this smart money versus dumb money, the percentage of stocks above the 200-day, the percentage of stocks above the 50-day as well, we can see that yes, the reads are very low right now, but we can indeed go lower. So just be careful, be cautious with your buying power, right? Don't spend it all at once. We want to be buying progressively into these dips as they get more and more attractive. So that is pretty much the context of where we are right now in terms of the market breadth. It is improving after the Friday session, but I wouldn't say that one session is going to solve all the concerns in the market that we outlaid, that the Federal Reserve kind of put into the markets over the course of the last week. So in terms of the pure technical analysis right now, well, we know that the SPY is in a daily downtrend. That is no secret, of course. Now we have come into an area of support, 586 down to roughly 577. Not too bad. And a lot of the reason for this bounce was, of course, the PCE numbers that came in on the Friday session. Those numbers were actually quite good. We were expecting 2.9 year over year. We got 2.8, and month over month expecting 0.2. It came in at only 0.1. That was pretty good. And even the price index coming down as well. So those numbers did help to kind of support the case for the bulls having a little bit of a rally. But keep in mind, guys, we were always waiting for a lower high, and the lower high has now been achieved. Will the bulls on the lower term timeframes, can they transform this into an hourly uptrend? If they can, your daily bounce will continue. Then we measure how much of this bounce can the bulls get back. Obviously, you want to see them take back a lot more. Right now, the bounce size was healthy, but it was only a 50% bounce. If the bulls can bounce a lot more coming into next week, of course, is the Santa Claus rally. If we can bounce maybe like a 618 or a 782 bounce, which would be bringing us right into this area of resistance, talking about 595 to about 600. If we can bounce all the way into there, it sets themselves up nicely to stop damage, possibly get an opportunity to reset the daily uptrend, or at least consolidate into some form of a tightening range. If the bounce only stops here, it's anybody's guess, but it does give the bears a good chance of retesting the lows and maybe even flushing to continue this daily downtrend. I will remind you, the Santa Claus rally, guys, the last 5 trading days of December and the first 2 trading days of January. So next week, the expectation, right? Monday is going to be the last 5 trading days of December, essentially, guys, is 1, 2 back here in terms of 2 weeks from now, and then 3, 4 Christmas is a holiday on Wednesday, and then Tuesday is a half-day session. So technically speaking, the Santa Claus rally does start on the 24th of December, which is going to be a half-day in the markets, and then should continue into the Wednesday, January 1st, and then Thursday, January 2nd as well. So we will see, guys. Can the bulls get it together with the Santa Claus rally and regain a lot more of this damage? Or will it be kind of like a Grinch sell-off market in which the bulls fail to maintain a lower high and unfortunately roll over and give the lower low to the bulls? And one thing's for sure, the bulls right now have to get the job done, guys, because on the weekly, we almost lost the weekly higher lows. We did not close below these levels, but we tested them in a very abrupt fashion, right? So now the weekly uptrend is still maintained by the bulls, but in the event we close a weekly candle below here, 583, we will lose the weekly uptrend. And once again, that opens the door for a very long road to get the weekly uptrend back. You see what happened here in August? We did eventually get it back, but you guys see how long it can possibly take, which is why you want to see the bulls maintain as close as possible to the all-time highs so they can just continue this weekly uptrend. Give back too much, and we may just be stuck in these levels right here, maybe even through the month of January. So I still maintain, guys, the best way to play this market is very cautiously. I am cautiously optimistic on the markets, but I am waiting for the levels to come to me. I'm only looking for very high quality, high conviction companies, which I'll show you at the end of the video by some of the new positions that we opened this week. And I'm just being patient and letting the market come to my levels and not chasing at all. Moving into the Qs right now. So the Qs as well, reacting nicely from support. 515 out of 510 is that area of support that we bounced out of, but we lost the daily uptrend, guys. Flush of the lows right here. It opens the door for the bears to pull in the lower high into possible lower low. We were always expecting a lower high. It just depends how high is that lower high. If it's all the way up here, you have a good chance of getting the uptrend back. But if this is the extent of the bounce and we roll over, as measured by the hourly, if we cannot get this hourly trend change in motion and we just start rolling this over, it means your daily bounce is finished after 1 day of bounce. And look at the fibs, guys. The bounce is not that solid on the Qs. Once again, only a 50% bounce. 50-50, guys. It literally gives the bulls 50% chance of being able to do it, reset the daily uptrend, or gives the bears an opportunity to resume either retesting the lows or flushing the lows and going for one level lower around the 500 to about 490 range on the Qs. So next week is absolutely crucial to gauge whether or not the bulls can continue the bounce and give themselves some good odds of continuing this weekly uptrend, because it is indeed still a weekly uptrend, right? Anything above 495, looking for the weekly higher low for further trend continuation. But if they cannot get it done over the next 2-3 days of trading, guys, we will possibly be rolling this over and we will possibly going into further weekly consolidation. The 12 EMA is down here, 506, and then support, of course, 500 down to 495. I still am very bullish on big tech names, and we'll take a look at a few of my favorite setups later on in the video. Moving on to XLF financials right now. So financials also benefiting from a little bit of the bounce on the Friday session, of course, guys. However, we still have a gap to be filled, which is the post-election gap down here at about 46.68. That being said, the context is still this big daily downtrend. The bounce is nice, but the bounce size for now is only roughly a, once again, 50% bounce. So the door is open for the bears if the bulls cannot complete this hourly trend change. It looks good. We're above the moving averages. We're above the resistance range. Same for the SPY, same for the QQQ. If we roll this over into next week, though, it's not going to be looking good. The bears will have a chance to either retest the lows or breach even lower. This last support line down here, 47.70 to 47.15, come through that one, and we are going for the gap fill, 46.68. So pay attention to that, guys. In terms of the weekly is still in the context of this very nice weekly uptrend, but the bears have taken back a lot of this move so far. The damage needs to be stopped right now, because if we fully engulf, it's not going to be looking very good. Best case scenario, we end up with a tightening range. The worst case scenario, of course, is the lower high into lower low. And keep in mind, guys, we have the bank earnings coming up. Well, you can't see me because my big head's in the way. Bank earnings, the week of the 15th, 16th of January is when we start getting a lot of these bank earnings again. So just a few short weeks until that time. So you would like to see the bulls maintain as close as possible to these all-time highs to give themselves some space. If the earnings are underwhelming, at least we don't flush too low. If we are down here by the time earnings happens, and then we get a bounce like this and earnings are bad, you guys know what's going to happen. We're going for the weekly downtrend and going for further and further monthly consolidation. Good thing for the bulls, a ton of space on the monthly monthly, guys. At this point in time, anything above 40, just gonna be looking for a monthly higher low for further trend continuation. So we will see, coming off of monthly overbought conditions, the weekly, look at the MACD, guys. The weekly MACD is not looking the best right now. The bulls absolutely need to play defense, but financials is an area that I will be interested in bidding, but we have run an absolute ton since the election, and I'm still not convinced that is the proper time to be bidding the sector right now, at least not before those Q1 earnings. I'm probably going to want to see those Q1 earnings before, but as of right now, no major red flags. I'm just kind of setting the tone for the foreseeable future. Moving on to XLV. XLV also had a nice little bounce on the Friday session, but you could see they could not hold up the gains at all, closing towards the low of the day. So that being said, daily downtrend is still in motion for XLV right now. We are looking for the size of the bounce, guys, and it's all in this hourly trend. Can they get the hourly trend to consolidate and give us a nice hourly uptrend? No hourly uptrend this entire move down. If they can get it done, well, your daily bounce is now finally underway, but they have a lot of space, guys. They have a lot of work to do. I will be quite honest. We have to get a bounce at least up to about 142, 143.50 to give the bulls the best chance of setting back into a daily uptrend, because as of now, the bears are in control of every single time frame, right? We have rolled over the monthly time frame right now. The weekly has been in a weekly downtrend ever since pretty much the start of the month of September right here. And we know that with the incoming Trump administration, there's a lot of uncertainty surrounding pharmaceutical companies, surrounding what they plan to do in terms of Medicare and Medicaid. So uncertainty around the health insurance providers as well. It's just a sector right now that is plagued with uncertainty. So I'm not saying I'm not bidding right now. I actually did start a position on one of the major healthcare companies. I'll show you it at the end of the video, but it's a sector that's very, very uncertain right now. So if I am bidding, I'm bidding the most high quality companies, and I'm bidding very small. That being said, moving into SMH, SMH continues to be a tale of being trapped between two ranges. Trapped between overhead resistance of 250 up to 260 and downside support of 233 down to about 220. We are just trapped, and we have been trapped arguably since the month of September. 3-4 months of doing nothing but going in a sideways motion right now. No clear trend direction at all right now. So we'll keep our eyes peeled, guys. The best way to play this one, in my opinion, is I'm sticking with the most high quality companies of the industry right now, which in my opinion are TSMC, AVGO, and NVIDIA, and I'm playing those with short puts, writing puts under the market towards big levels of support, and not really looking to play much in terms of short-term direction. I'm building some positions for 2025 because we know what the semiconductor industry has been doing so far, right? Let's have a look at a few companies. I'll explain to you exactly what's happening. This is a very cyclical industry if you are confused, right? Very cyclical industry. If you look at a lot of these companies' charts, they all look the same. There was a huge boom in 22 and 2023, a lot of pulled forward demand in terms of the AI ramp for data center purposes, and also PC and personal electronics. A lot of free money, a lot of stimulus money was had in 2021, 2022, and now we've been kind of in a lull period in late 2023 and even all into 2024. Here is, LRCX, right? You can see that. Look at the EPS trend. Boom. Now we have a little bit of a shallow trend, right? Cyclical nature of the business, and then expansion into 2025. That's EPS, and this is revenue as well. On Semi, which manufactures a lot of parts for personal electronics and also vehicles too. Take a look, same concept, right? Down in EPS, 2024 transition, and then you have the boom 2025 and onwards. You can see this all across the board, guys. Pull up your favorite semiconductor companies, and all of them, or a lot of them, have this exact same chart. There is MCHP, here is Micron, same concept as well. Boom period, cyclical period of the business, and then boom again into 2025. So that is going to be the case for SMH. I do believe that these are worth a bid right now, but we have to be very patient with the sector because it has been out of favor since the month of July. Moving into the IWM Russell. So the Russell also sacrificing a major level on the last week's session, right? As you can see right here, we broke through this whole 230 down to 225. This was the last line of defense for the bears right there, 2021 and 2020, and now they have got it back, right? We breached above and now we have closed below. So a failed breakout pattern. Look at this monthly chart. If the bulls are not able to get a lot of this back by the end of the year, this is going to be a massive supply zone. And what does that mean, guys? It's an area that is going to be very hard to get back above. That being said, daily downtrend is clear as day right now. Couldn't be more clear right now. And if we're looking for a lower high, that's all we're looking for because it's daily downtrend. Overhead resistance, of course, might just be a lower high, and then it's up to the bulls. Can they reset into a daily uptrend, Or do we just set a very shallow bounce, roll over, retest the lows, and lower? If they do come lower, guys, down here is the next big area of support. 215 down about 208. This is an area that I might consider bidding once more. I did close my Russell position on the Thursday bounce up here and might be looking to reposition, but I need to see more consolidation in the sector, more clarity from the Trump administration, more clarity from the Fed, because they just killed the risk on narrative last week as a whole, guys. Interest rates higher for longer, possible resurgence of inflation. Those are two things that the small cap index does not want to hear or see at all to really benefit from some of the crazy rallies that everybody expects them to see. So right now, the sector is a pass from me, but if we can consolidate a little bit more into these lower levels, I may be reconsidering a bid, possibly in the next few weeks of time. But as of right now, I am out as a whole. I'd rather focus on the most high quality companies and the clearer setups, in my opinion. Moving on to the Dow Jones right now. So the Dow Jones up 1.18% on the Friday session. Not tremendously bad, but like I said, guys, one day of bounce is not going to undo 2 weeks of downside, right? This is a clear loss of the daily uptrend in one clean swoop, loss of the 43,000 level. So now looking for a lower high. Where's that lower high going to be? Well, look, take a look at the size of the bounce right now. Only a 30% bounce. It is not good enough. So in the event we cannot get this hourly uptrend in motion and give ourselves a little bit more lift on this daily bounce, let's say we roll over the hourly into next week, roll over, what do you think is going to happen, guys? We have a very high probability of retesting the lows or ending even lower and perpetuating this daily downtrend. In terms of the weekly as well, the weekly uptrend has been lost. 43,000 was the weekly higher low. Unfortunately, we have now closed below it. So at this point in time, guys, not looking the best, right? I'm not saying that they can't get it back. You can see right here, loss of the weekly uptrend. They took a long time to get it back. So in this case, the V-shape might be unlikely, but can we have an extended recapture eventually of the weekly? Yes, but the bulls need to stop the damage right now. We clipped into the 26 EMA. 26 has been a nice area of defense for the bulls pretty much all since that November 2023 rally. So it remains to be seen. Can we hold or do we push even lower and lower and lower into further and further monthly consolidation too? Good thing for us. The monthly bulls have a lot of space right now. Anything above, let's call it on the monthly, anything above 38,006, just looking for a monthly higher low for further trend continuation. So possibly end of December consolidation, January consolidation as well would not be off the table, guys. And this is the thing that I want you guys to take away from all of these indexes, right? Look at the monthlies. We can consolidate into January and then rally for the rest of the year, and it would not look so crazy, would it? Consolidate into January and then rally wouldn't look too crazy. Financials, consolidate into January, rally wouldn't look too crazy. Healthcare, consolidate more into January, then put together some form of rally when we get more clarity on policy stance, wouldn't be so crazy. Semiconductors, more consolidation into January and then rally into 2025 wouldn't look so crazy. The Russell, same thing, more consolidation into support in the month of January and then rally wouldn't look so crazy. So give that as your baseline scenario, right? Expect that the month of January is going to be a volatile, sideways, or downwards month. And anything better than that is going to be a very welcome bonus. But if we're in the mindset of hoping, hoping for the best, but expecting the worst, you will see that you get a lot more conservative on your trades, a lot more conservative on your entries, and you'll have a lot more patience, right? The word pay is in patience. So patience pays, guys. So draft a watch list out there and be patient. Wait for stocks to come into your support levels before positioning, right? Like I said, 1 day's worth of bounce should not convey any FOMO in anybody. You guys should be really patient right now because we did lose the daily uptrends and weekly uptrends across a lot of these sectors. Moving into our subsectors right now, XLP, consumer defensives, basically the Walmarts, Costco's, Coca-Cola, Pepsi's, Procter & Gamble's, tobacco companies, all of this stuff up here. How is that doing? Well, as you can see, they tried for the weekly uptrend recapture, couldn't get it done. Now we are back into weekly consolidation, back into monthly consolidation as well. Below us, 79 down to about 76 area of consolidation. Can we possibly see more consolidation into January before more recapture? Yes, and it would look completely logical on this chart. So I am staying firm on being very patient on even the value and defensive names as well, because we have most recently lost all of the weekly momentum. So I will be very patient on a name by name basis. Utilities. Well, utilities, of course, why are they reacting? Because of yields. An extremely sensitive sector to interest rates is utilities, right? So as these yields keep moving higher and higher and maybe stagnate in the high fours on the 10 and 20-year yields, well, utilities is probably not going to be a very favorable sector in the future. They've also lost the weekly uptrend, now possibly looking for a lower high and maybe best case scenario, some sideways consolidation, because I definitely don't see a world where interest rates stay high because the Fed is now keeping them higher for longer and may pause in January. I don't see a world where we see utilities skyrocket like this. Best case scenario, maybe a tightening range. Worst case scenario, maybe a weekly downtrend. Look at the monthly, guys, right? Monthly uptrend. Would it look so awkward if we do one more month of consolidation into January, coming back into prior all-time highs for a new monthly higher low into the moving averages? No, it would not. So I'm once again being very patient on any utilities plays. Real estate, same concept, guys. Rates higher for longer absolutely killed this sector on the Wednesday session. It was already not doing too good with the drop in value and the drop in the Dow Jones, and now it's just basically given everything back. So forfeiting the weekly uptrend. Weekly downtrend is now in motion, which means we're into monthly consolidation, looking for a monthly higher low. Anything above 35, going to be looking for a monthly higher low into previous resistance, which should now be acting as support. One more month of consolidation. Would it look so awkward before resumption of a longer duration monthly uptrend into late 2025? No, but right now, real estate is not the best look for the markets right now. It is a byproduct of rising yields. So I'm staying away, guys. I am staying away. If the concerns right now are a resurgence of inflation and rates higher for longer, very simple. I'm going back to what I've been doing for roughly the last 6, 9, 12 months. I'm going to play the sectors that are not being affected by either rates being higher for longer or through inflation whatsoever either. And mostly that is going to be any names revolving around the AI narrative, and more specifically big tech, because they're so cash rich and do not rely so much on interest rates. So I still think that the best trade for 2025 most likely will be big tech and also the AI narrative names, because they are ramping up and their production will become more and more efficient as a whole. And lastly, our energy sector. So energy, of course, continuously being out of favor right now for a few key factors. Winding down of geopolitical conflicts across the world. Number 2, oil is seasonally out of favor, at least until mid-February. And number 3, Trump is coming into office, guys, and his slogan is drill, baby, drill. If you drill for more oil and put more oil on the market, what do you think is going to happen to the price of the barrel? The price of the barrel is going to go down. The cost of energy is going to go down. The company profits of the energy sector are going to go down. So that being said, this is why we've now lost the monthly uptrend as a whole, or we will be soon if we close down below here. Loss of this attempt at a breakout pattern, and now we're just into more consolidation. We've been consolidating for the last 2 years, now coming down to the lower levels, 80 down to 74. So oil is another sector that I don't really feel a need to be bidding right now at all. So, a lot of these sectors, right? Healthcare, too much uncertainty for me. Utilities, too much uncertainty for me. Interest rates. Real estate, too much uncertainty for me. Interest rates. Energy, too much uncertainty for me. Trump policy and also unfavorable seasonality, unfavorable geopolitical conflicts for the price of oil. So for all those reasons, guys, I see no reason to bid any of those sectors right now. Now, moving in further, guys, in terms of the VIX, well, the VIX obviously had the massive one-day spike. This is the second largest intraday spike that we've had over the course of the year, and one of the largest intraday spikes that we've seen in all of history, to be quite frank with you, right? 70+% in one single day, nothing to scoff at, that's for sure. Friday session did a great job of bringing all that down, but be very patient, guys. You saw, after we had this big volatility event, look how long the VIX stayed between 15 and 20 before coming down into more normalized levels after the election. Could we stay at somewhat an elevated basis between 15 to 25 ever in the foreseeable future through January? Absolutely. So I wouldn't say the volatility is dead just yet. That being said, keep an eye for some sticky volatility maybe through the month of January as we kind of move through this uncertain period. Now, in terms of the yields, well, the yields, guys, they're coming back, but they are now normalized. As you can see, everything is now back in order. We are no more inverted on the yields, right? The 10 is above the 2, the 20 is above the 2 as well. So now yields are back to being normalized, and they can stay at these heightened levels for a very long time. The 10 and the ones that most closely follow the Fed funds future rate are the 6-month, 3 6-month treasuries, the 1 and the 2 year. Anything beyond that, guys, is pure speculation. There's too many catalysts at hand right here. 10 and 20 year is all about the speculative nature of the bond market, right? If people do not want the bonds, these yields will keep going higher. The only time these yields are going to go lower is if you get some crazy demand in 10 and 20 year bonds. There's a reason why nobody's buying them. Number one, the levels of US debt. The levels of US debt right now are pretty extended. Now, we do have Elon and Vivek coming in, implementing the Department of Government Efficiency. We'll see what they can do to reduce government spending and reinstore confidence in US debt, but other countries and institutions right now are just not buying US debt. So these yields keep just drifting higher right now. As a matter of fact, a lot of institutions are short bonds, which means they're long on the yield curve, right? A lot of speculation in these right now. Too many factors, and even Jerome Powell. Don't take it from me. Just go watch Jerome Powell's speech. He was asked about this directly, and even he said that this is a very, very complex trade. But these yields are largely out of the Fed's control, especially when the Fed is not doing quantitative easing and not buying any of these bonds either. So tough for a lot of people to follow the Fed into this trade if the Fed is not even buying their own longer duration, T-bills. So moving on further, guys, same thing for TLT, right? TLT can be a good trade into 2025 and 2026, but you need to extend your time horizon, guys. This is not Palantir right here. These yields are going to take a very, very, very long time to move. That being said, if I had to position in any contracts, it would probably be for end of 2025, even June 2026, and I'd be going very close to the money, $90 calls for December. Not financial advice. If I'm looking to do it though, maybe some 90 calls for December 2025 or June 2026. You're going to need a lot of time on this trade, guys, because it's a very complex topic. Moving into our last two things right here. So gold continues to be somewhat of a muted sector right now. This one too, guys, very, very complex trade, right? Sometimes it acts as a hedge for the markets when there's high levels of uncertainty, but you guys saw what happened on Wednesday, right? A lot of fear came into the market. Did people rush to gold? No, they sold off gold too, right? So sometimes gold, it runs in with correlation with inflation. Sometimes it's used as a fear proxy, but other times it just doesn't respect any correlations whatsoever and kind of does what it wants. So kind of just in a tightening range right now. Big levels to watch, 25 for the weekly downtrend. If we break, however, to the upside, 27.21, that would be a reconfirmation of the weekly uptrend. Just a massive tightening range right now, guys. So I would say gold is a very complex trade, but on the monthly, I'm not really looking to buy this one. If we can see some further pullbacks into maybe 24, I would get a little bit more interested if we can retest this 12 EMA, then maybe for a leg higher. But right now, monthly overbought on gold, probably not for me. And oil, well, we described it when we went over XLE. Oil is just out of favor seasonally right now, and it stands to argue that if Trump comes into office and unleashes the barrels of oil, what do you think is going to happen to this chart? It's probably either going to stay flat or possibly even drift a little bit lower and find some support back here in the normalized rates where Trump was in office back here. You can see the highest that the barrel got under Trump's presidency was not much higher than it is right now, 74. That is what happened, guys. You cannot expect, oil companies to surge with profits. It most likely will come to a normalized rate, probably between the 50 and 70 range, maybe over the next 2, 3, 4 years. That is why I'm not really bullish on oil myself. Now moving into crypto. So crypto as well. We saw a notable shift last week, guys. Crypto as well having some big liquidation events. We'll cover Bitcoin first, and then I'll show you the altcoins, right? But before, Bitcoin, as you saw, right? Wednesday, the event on Wednesday took Bitcoin down. They were on a tremendous rally prior to Powell. We had the daily uptrend, and now everything has come undone, guys. We lost the higher lows at 99. Higher lows are now dead. So now the bears have the lower low, possibly using this whole area of prior resistance, which was support, but we blasted through it, now resistance again. And now, guys, we are below the 26 and 12 EMA. We have not lost the 26 since the election rally. So it has to be notable to you. Once again, flush of the daily downtrend, set the lower low, possibly setting the lower high right now, using resistance as the lower high. Can we possibly see a revisit of lows? Very, very possible, guys. Look at the weekly as well. Big weekly move from the bulls. Weekly higher lows are all the way down here, 64,006. Can we see a possible retest of the support range down here, 91 back to 86, 12 EMA? We can absolutely see those levels again, guys, especially with all this uncertainty and volatility in the markets. You guys know the one most volatile asset class of them all is crypto. I know Trump's administration are quite pro-crypto in terms of their bullish stance on it, but the volatility in the market right now, the shift that we've seen after Powell from risk on to risk off right now is not going to help Bitcoin at all. Can we see some volatility in Bitcoin and even some declines early December into early January and just go into possible even monthly consolidation after this nice 3-4 months worth of rallies? Absolutely, guys, and it would make perfect sense if we retest the low 90s to mid 80s even, set up some monthly higher lows, and then embark on maybe a better journey come early February. So keep that in mind, guys. I'm not saying that we can't just undo this and rally, but always the same thing, right? You can hope for the best, but if you're expecting the worst, you will be very cautious in your positioning and you will wait for the most attractive levels to be purchasing Bitcoin at. Myself personally as well, I am waiting for any further Bitcoin positions, and that is the same thing, guys. Talking about Bitcoin, talking about MSTR, of course, talking about the BITX 2 times leverage ETF as well, talking about the miners, talking about Coinbase, talking about Square, talking about Robinhood, everything that rallies with Bitcoin, I'm going to take somewhat of a cautious stance. It's been a very nice rally for the last 2 months since the election, but now into the inauguration, can we maybe seeing a little bit of uncertainty, a little bit of a sell the news event? Absolutely. And what's been struggling more so than not have been all of the altcoins. We've been paying special attention to this Bitcoin dominance chart. As you can see, guys, Bitcoin dominance right now, not looking the best, right? So we had the weeklies. They were embarking on the altcoin season rally. And now look at this dominance chart, has gotten it almost all back. Can we possibly see a lower high and maybe further into lower low? Yes, but you'd much rather see a lower high down here before the rollover, right? Lets you know that altcoins can retain a lot of their levels. What we're seeing right now is somewhat of a flight back to safety, right? People got scared after the Wednesday session and now refusing to bid up the altcoins and now pivoting back into Bitcoin, which is helping Bitcoin maintain a relatively stable price, but the altcoins have been suffering. Take a look at Ethereum. Ethereum down how much? From the highs over the course of this week, 25% top to bottom. Ethereum losing all of the levels, trying to set up for the weekly higher lows right now. It's good for them. They have a lot of space. Anything above 23, looking for a weekly higher low for possible further trend continuation. But if we pull back too much, guys, once again, we're going to be trapped and the bulls will have to start everything from scratch, maybe only be able to reach these highs once again end of January, early February. That is the nature of possible monthly consolidation. It can take months to recapture. So it sucks. I know it sucks, guys, but you can thank Jerome Powell if you want to thank anybody for that. The altcoins are all the same. Look at these declines. I'll put it on the weekly timeframes, right? Huge rallies up after the election, much needed consolidation. That's Cardano. Here's Aave, one of the favorite AI names right now. Huge consolidation, and consolidation can continue. Aptos, massive consolidation. Arbitrum, massive consolidation. They're undoing all these moves. Avalanche, massive rally, massive consolidation. It takes 1 week and you take away weeks and weeks and weeks of gains. I can go through this entire list, guys. Binance Coin, BNB down. Some of the biggest meme coins. Brett on base had a tremendous rally, boom, down. Dogecoin, tremendous rally, boom, huge flush as well, right? You can look at all of this list and they all look the same, guys. Everything is pulling back excessively hard. So I think that it's going to be an environment of caution. I am going to be buying the dips, but buying the dips very, very slowly on altcoins over the next course of the next 1 month, because we have the longer duration uptrends, but now we do not know how long this consolidation can last and how deep they can cut it, guys. It is crypto. Welcome to crypto. You can have very violent moves to the upside. They can pull back 40, 50, 60, 70% and then still rally on to be higher. But you just don't want to get trapped, especially if you're on leverage. So be very careful with the altcoins. I am saying that the altcoin dip right now, look at Solana. Almost gave everything back, right? It's a decent time to be buying, but we have to bid small. We have to DCA into it, knowing that we're looking for a lot of these monthly higher lows, but we know that could take possibly some time to resolve this, possibly through January and early February as well. So that's everything for crypto and the indexes. We did a big rundown, guys, because I think it needed to be done. This is going to be one of my longest last videos. There was a lot to cover this week. It was one of the biggest last long video for me. And then moving forward, every single one of these videos, guys, will be 40 minutes or less. I've been saying it for a while, but now I really have to do it. We're going to be doing it. We're going to be cutting down the times on a lot of these drastically, just to be more favorable for the algorithm and to respect your guys' time as well. A lot more detailed analysis will be provided in the Discord, of course. However, in terms of the YouTube channel, I'm going to be cutting down on these times a lot on the channel, guys. So hopefully you guys understand. I've been saying it for a while, but now into the new year, it's time to kind of put what we've been saying to practice, as they say, right? So moving into Apple right now, Apple not looking too bad at all, but watch out, guys. Daily, look. Daily highs, look at this RSI right there. This is bearish divergence. When you see higher highs on the price, lower highs on the RSI, lets you know that something requires our attention and something just might be wrong. So 1.88% to the upside, looking very healthy for Apple right now. They did not lose. This is one of the only names, guys, that they never lost the daily uptrends, right? Daily higher lows were set planted right there at about 246. Let's call it. You can make an argument that they're right there. They did not lose that support, did not lose the 12 EMA, now looking to move higher. However, if the next week unravels, well, you guys know what's going to be the case, right? Maybe only a double top right here. If we roll over these lows, 246.50, that would be a daily downtrend heading into much needed weekly consolidation. Apple has ran a ton the last 5, 6, 7 weeks, and any pullbacks will just be for that. A very healthy pullback. RSI is getting slightly overbought right now at 72. I would not be surprised if a pullback is coming. Where could we maybe pull back, guys? 240 down to roughly 230 is going to be the range for a breakout, retest, and possibly run on Apple. I'm not buying any Apple up here, not at all. I'm holding my long-term shares, yes, but no swing trades for me, guys. It's too far extended. The risk reward right now is not the best, so I will be looking for a pullback on Apple, to say the least. And we know the PEG ratio right now at about 250 is standing at about a 3.5. Very high valuation right now. So I'm not buying, I'm not selling, I'm just holding what I have, but not initiating any new positions. AMD continuing to struggle down to about 119. They were up slightly on the Friday session, but still, I mean, AMD, let's be honest, right? Absolutely crushed. We do not have any time frames right now. We do not have the monthly downtrend. We do not have the weekly. Weekly is also in a weekly downtrend, and we also do not have the daily. Daily is also in a daily downtrend. So what do the bulls need to do right now? Well, we're coming into the last line of defense, 200 weekly EMA at 114, and support below that, 114 down to about 105 is roughly the mark. You can see that usually in AMD's history, it has been a good opportunity to buy when we are when we are at the 200 weekly EMA. So now we're coming into kind of the last area of defense, and the valuation right now, guys, I will be honest with you, the valuation right now is very cheap. We are also daily oversold. So I've been saying this for about the last week of trading. I think AMD is ready, but I'm not saying I'm going to be picking the bottoms, right? But 120 down to about 105, this little pocket right here is coming in my opinion, to, the nibble territory, the start building a position territory if you are at bullish in the company and understand the company's thesis. At 125, the peg is down to about a 1 peg. Very cheap valuation for all of this growth. I'll remind you what the thesis is. The thesis is the ramp of EPS, the ramp of free cash flow, and the ramp of net margins and revenue in the face of the data center application ramp. Here's your revenue, here's your EPS. So that is going to look very good for the company, which can give them some outsized gains if they can reverse this short-term bearish sentiment in the stock right now, right? I'll remind you, all the analyst price targets are all considerably above the share price right now. So right now, decent, attractive opportunity for a very high-quality stock, in my opinion, but it may take a little bit longer than you guys think. The bulls need to do everything from scratch. First, we need to see a weekly or daily engulfing bounce, at least 50, 60, 70% bounce when they find a bottom, right? Need to find a bounce. If we come all the way down here, need to get a 50, 60, 70% retracement set up for the daily uptrend. Only then will you know that the weekly lows have been set. And then we're maybe also looking to start a reversal on the weekly time frame. But we're looking for the everything recovery at this certain point. So right now, I'm playing it, but I'm playing it slow. Yes, I have opened a few positions on AMD lately, and I'll show you guys that at the end of the video. I am playing this one very slow, very cautious, and waiting for it to further come down into my further levels. Into Amazon right now. Amazon also not doing too bad either. I mean, they recovered a decent amount from the Wednesday flush, but as you can see, not all that much, right? They did recover a little bit, but coming only into Thursday's high. So at this current time, right, the daily uptrend has obviously been lost, and now the bears are looking for the lower high into lower low flush. It all relies on the hourly time frame, guys. If we cannot get the hourly uptrend confirmation and we just move lower, well, you guys know they've set up the lower highs, possibly looking into the lower lows, and that would just continue into our weekly consolidation. Amazon's long-term timeframes look very healthy right now. Weekly uptrend looking for a weekly higher low for possible weekly trend continuation. And the weekly higher lows could come all the way down here. 214 down to about 205 is the pocket, previous resistance, newfound support, and the 12 EMA, which has been acting as some great defense for the bulls since we lifted off here from the area in September. You guys can see, usually the 12 EMA, when we do have a nice uptrend, guys, is a nice area for the bulls to pull back into. There'll be no change there for Amazon. Amazon should have a very good year in 2025. One of my favorite companies leading into the new year. It's just right now, similar to the rest of big tech, we're trading a little bit extended from the levels right now. So pullbacks can be seen, and I will be waiting here to go shopping for more Amazon. Moving into Google right now. So Google up about 1.72% on the Friday session. Google as well, right? They had a very nice daily uptrend going for them, but they have flushed the lows right now. And even with a very nice bounce on the Friday session, that's all it is. It is just a bounce. Look at the hourly timeframes, as a matter of fact. We have not confirmed a new hourly uptrend. That will be a break of the Friday highs. If we can get that, perfect, then it means your daily bounce is still underway. We'll be looking for the bulls to get the daily uptrend back. However, if we continue lower into the Monday session into next week, hourly downtrend, well, you guys know lower highs are set and possibly looking for lower lows. If that is the case, where are we heading, guys? Well, we're heading back down into this range right here. 180 down to about 175. It is the liftoff zone for Google. Weekly uptrend is nice. Looking for the weekly higher low for further trend continuation. We're reacting a little bit from the support range up here, 190 down to 185. But if the markets continue selling off, SPY and QQQ, expect Google to come very quickly back down into the 180 to 175 range, which I should turn into red because into green because they deserve it. That is the next closest area of support, and where I personally will be going shopping for a little bit more Google. So I'm going to be patient with all these names, guys, but if they come into these levels, I will be going pretty aggressive, but we have to be patient leading into them, right? Now, moving into Meta, another stock that was kind of struggling over the course of the last week, right? So Meta down about 1.73 on the Friday session. No secret there, sacrificing the daily uptrend now, unfortunately, into the daily downtrend. So daily downtrend continues right now, kind of coming very, very hard and hot into our support area. 598 down to about 580. If you flush this next week, guys, well, it's just going to continue this weekly consolidation. Good thing for them. A lot of space. Anything above 546, looking for a weekly higher low for possible further trend continuation. Look at this weekly candle, though. The bulls need to play defense literally starting Monday, because if not, we're going to take back too much of this move and once again get trapped in this consolidation range between 600 and 580, and the downside down here, 540 to 530. These guys all the way back here, right? I will be looking for Meta. If we come back down into this range, I'll be looking to play them there. Why? Because we'll just be looking once again for a little bit of monthly consolidation back into this range of support. I do think Meta will have a fantastic 2025, but it may be a little bit bumpy coming into the January session. Meta has been overbought on the monthly now for a few months in a row. Could we maybe see a one-time flush of expectations back down 540, 500 into January if the market gets really bad? Yes, and I will be sitting here for a buying opportunity. I'll start buying 550, 540, and I'll keep buying all the way through the lower 500s if we come down there. But I'm just giving you the levels where I'm going to be buying Meta aggressively if we come into it, and that starts at about 540, 540 down to about 530 first touch. But as of right now, guys, no major red flags have been lost. They haven't even lost the weekly time frame just yet. So right now it's not looking bad. I'm just giving the expectation for the future. Microsoft also, Microsoft had a crazy volatile day. Look at this downside starting off the day, almost 2% to the downside, then bottom to top, literally 3.5% bounce on Microsoft intraday, and then the volatility simply continued all throughout the day. Same concept as the rest of big tech. What are they trying to do? They're trying to get the hourly trend back in control, which means they're trying to go for the daily bounce. However, if we do not get more than that and we roll this over hourly downtrend, you need to understand this was the extent of your daily bounce and might just be looking for the daily downtrend. Good thing for them, coming into big support right now, they did start reacting. 435 down to about 422, and that is the previous area that we just cracked through very nicely, and now we're going to be trying to use it as support for Microsoft. The 12 and 26 moving averages are there as well, so you have a lot of support from Microsoft bulls, but Microsoft cannot do it alone, guys. If the SPY and the QQQ choose to consolidate more, Microsoft will be coming lower and lower. We'll see if the bulls can play defense, but worst case scenario, we're going to get once again trapped back in the range that we've been trapped in all or most of 2024. As of right now, no signs of that. Looking for the breakout retest trade, and I have a few positions on Microsoft still, but if it doesn't happen, guys, do not act surprised. my true buying area for Microsoft for more call options, more call debit spreads will be down there. As of right now, I'm playing it with a few strategies, but the heavy buys come in this lower range down there. So we'll keep our eyes peeled on Microsoft. Moving into Netflix right now, Netflix also continuing on the daily downtrend. We will see, same thing as the rest of big tech. Can they get the hourly trend change and get the daily bounce to move a little bit higher, recapture the daily uptrend, or will we just set a lower high and roll over, in which case we are going into further weekly consolidation, and Netflix needs it, guys. Weekly overbought for the last 5-6 weeks in a row. Netflix usually does not stay this overbought on the weekly, at least not for a while. They haven't, right? If we consolidate a little bit more, where are we coming down to? Probably coming back to tag the 12 EMA, guys, at least 850 down to 840. That's going to be the region for the 12 EMA. Looking for a higher low, anything above 742. So as of right now, the bounce is nice, but it does not guarantee anything. If we get some further downside follow through, guys, understand what we're looking for here. More and more weekly consolidation. In that case, more and more monthly consolidation. If the month of January is red, I'm pretty sure it would not surprise anybody if Netflix puts in a red January, a red early February, and then resumes trend through 2025. That wouldn't look so awkward, would it? So just keep that in mind, guys. This is a very real case scenario, especially with a monthly RSI up to about 77. Right? So just keep that in mind. Now moving into NVIDIA. So NVIDIA up 3% on the Friday session. NVIDIA with a very nice bounce. They had a daily downtrend going for them. They were looking for another flush, but the bulls said no. The bulls are trying to create a bounce scenario right now. Any bounce above the high of this candle, not too sure if you can see it, 136.55 is going to be the mark. Bounce above this, guys, you actually have a daily uptrend on NVIDIA, reacting nicely from the 130 down to 125 support, which is the area that I was saying could be very juicy for a little bit of a swing trade to the upside. That being said, if they do get the daily uptrend in motion, we'll be looking for a weekly move higher. It is a weekly downtrend right now, but if we do get that lift on the daily uptrend, guys, understand what we're going for here. We're going for a weekly trend change attempt. It could take some time, but NVIDIA is reacting nicely from these levels. If the whole market falls apart, we do not get the Santa Claus rally, and we just roll over lower and flush the support range, I'll let you know. We are just still going for the continuation of this weekly downtrend, and the next big area of support for me, 119 down to 115. I'm bidding NVIDIA in this level, but my big call options and stuff like that will come down here, 119 down to 110. This pocket, I think, is a very attractive opportunity for long-term positioning with some size for NVIDIA for the next foreseeable future. Now, moving on to Tesla, shall we? So Tesla down about 3.46%. You can see, guys, the weekly candle not looking the best at all. Let's tackle it from the daily, however. So daily, still a very nice daily uptrend, looking for a daily higher low, and support range stays put at 410 down to about 375. We will see how the bulls react to this zone. It is the first line of defense, which is the previous all-time highs from all the way back there. So we'll see how they react to it, but we're definitely coming in hot right now off of the back of overbought conditions. I was warning up here, guys, when Tesla gets to an 85 on the daily RSI, you usually do start to see a little bit of a pullback. Even when the market is so bullish around the company, pullbacks are completely normal. This weekly candle close, however, leads us to believe that further downside throughout this week may indeed be possible. Once again, we'll see how we react to these levels. The bulls do have a lot of space, though, at this point in time. Anything above these guys down here, 335, let's call it, just gonna be looking for a weekly higher low for possible further trend continuation. It all lies on how we react to this, guys. If we just flush as if this zone is not even here, well, obviously the expectation goes into somewhat of a tightening range at the best case scenario. The worst case scenario, of course, is a weekly downtrend into the month of January, which could lead us into some monthly consolidation, which would be required for this stock. It has run a ton in the last roughly 2, 3, 4 months at this point in time, but the bulls right now not losing any major levels. The key is going to be watching how they react to these levels. If we come down into here hot as a whole, get into some 4-hour, some 1-hour oversold conditions as we're approaching right now, it could be an opportunity to write some options, writing some short puts in the 360 down to about 330 level if we come down into here hot, because then we could be seeing a little bit of a bounce, but it's just, will the bounce result in a lower high and lower low? That is something that we do not know. We will take this one week at a time, but Tesla right now, not looking bad at all. They have not lost levels, but we have to acknowledge with a weekly candle close like this, coming out of weekly overbought and daily overbought conditions, the downside could be a little bit more extended than some people are possibly anticipating, but we'll keep an eye on it every single day this week. And now Palantir up 8.54%. So when the bulls come back in Palantir, they come back in a big way. Palantir has never lost the daily uptrend since all the way back here. Beautiful, gorgeous daily uptrends higher low is set. We were talking about this tightening range, watching for the break to the downside or to the upside, and they chose to break it to the upside, continuing the daily option right now. Overhead resistance stays put at pretty much where we are right now. These are the all-time highs. The next psychological level, of course, is 85. So we'll see if they can actually get there. Right now, the bulls looking in full short-term control of this chart. Any move lower looking for a higher low for possible further trend continuation, guys. The big level is, of course, going to be this one, guys, right? 72 down to about 70. If for XYZ reason, guys, Palantir somehow flushes these levels, you have to anticipate the daily downtrend, have to anticipate that weekly consolidation will continue. And if it does continue, probably going back to the 12 EMA, which is going to be sitting roughly in the, well, if we move down and this level catches up, most likely sitting in the low 70s to about high 60s, right? So we'll see if that happens, if it gets there. But right now, Palantir is looking good for a little bit of upside continuation, but I would be very cautious in positioning, guys. The risk to reward up here is obviously not the best, right? But all in all, the bulls looking very decent, no red flags. It's just, of course, everybody understands right now, even those of you who are the most bullish on the stock, right? You guys must understand the valuation right now makes absolutely no sense, right? So it's just pure momentum play right now, pure continuation play. We'll see how long it lasts. I'm not complaining because I'm a Palantir shareholder myself with some long-term shares that I'm not selling, but a little bit overextended right now in terms of price and in terms of in relation to the valuation. But momentum on the stock right now is very healthy. So that's pretty much everything for our stock market recap. Hopefully you guys enjoyed that extended recap. As I said, it's going to be one of the last of its kind. And now let us move into the juicy stuff, which is the trades that we made over the course of the past week. So let's do a quick recap here using the Discord as kind of the guide, because a lot of these trades are no longer in my portfolio. So I'll show you the ones that I did close. So SMCI, we had a few wheel trades here. I kept a lot of buying power last week because I saw the possible volatility event on Wednesday maybe being the most important for the rest of the year. So I held back a lot of buying power. So that's why there was not that many wheel trades for the week. SMCI, we wrote the 27.5 puts. They expired worthless because the stock ended above 27.5. We collected 1% there, 100% win. MSTR played it a few times, the 295 puts early in the week, 225 up until before Powell. We closed it at an 81% win on the day before Powell, or the day of Powell in the morning. NVIDIA as well. We played the 121 puts when the company dipped early on in the week. 63 cents, we got 0.5%, and we closed them for just about 11 cents. Once again, this one too was closed slightly before Jerome Powell. And then the last one, MSTR, we played that one on the Thursday session. So with some remaining volatility, we have the 282.5 puts, December 27th for 275. I closed them on the Friday session, guys, on the MSTR bounce, because I did not fully trust Bitcoin leading into the weekend, especially with how the altcoins were reacting and the risk off to risk on sentiment. I just didn't want to hold this one over the weekend and end up with some nasty surprises, because we know, guys, that MSTR, although they have been strong, they have lost a lot of major levels too. It is a daily downtrend right now. It is also not looking the best on the weekly, right? Also looking they want to shape up for a weekly downtrend. So no one would be surprised if MSTR just goes on a big consolidation move with Bitcoin. So to avoid all of the volatility and the fact as well that I got into that trade, to be honest with you guys, I did not get the best entry on this trade at all. We got into it early Thursday morning, and then it kind of dropped on us immediately. So when I saw the opportunity to get back out, we just got back out, secured some profits, guys. And if we drop a lot further leading into early next week, I'll be able to get more and more better levels out of this stock, right? You can argue that I had a lot of margin of safety, but the way I like playing MSTR, I like playing it with even more margin of safety, guys. And when we were back down here, I mean, between there and my assignment price of 282, only 22%. You might think it's a lot, but you know as well as me, MSTR can move 15% in a day and nobody really blinks an eye, right? I want to have at least 35% margin of safety. So if I can time this one with a big downswing on the stock back down, maybe into the 330, 320s, and unlock some of maybe the 250, 240 strikes for 1%, I will go for those instead. Didn't want to hold it over the weekend, chose to reallocate my buying power to something else instead, which I'll show you in a few short moments. Now, we are assigned a few plays as well on NVIDIA and Uber. We have 100 shares of NVIDIA at 137. Now, I'll show you exactly what's happening with those. So NVIDIA, we got assigned a few weeks ago at 137, 0.79 in put credit premium. We wrote the December, this week's covered calls at $1.18. We also did the 121, an average down attempt trade that was in the wheel trades earlier, right? This one right here was an average down attempt. It went very well. We didn't get assigned. We closed it for a profit. So we add that to our cost basis. And then we also rolled the covered calls from last week into next week again at 137 strike for $1.53. All of that premium minus our Stein strike price, we are now chilling at an average cost of $132.99, and NVIDIA right now is above that cost. So we're actually up on NVIDIA right now if we wanted to just close the trade right now for what it is. So that one's doing quite well. Uber, on the other hand, still down on this one, assigned at 66 with 42% in put credit premium. We wrote some covered calls last week for $66 on the bounce. 62 cents is what we received. Average cost on Uber now is $64.96. So Uber, although it is down, still around 60.73, the loss is not that large, especially since me and most of our members are only running one single contract. Now, here is where things get a little bit different in the trade setups, right? I closed a lot of the directional trades. I was telling you guys on Wednesday when I spoke, I said, this shift in Jerome Powell, this shift towards uncertainty from inflation possibly being a catalyst in 2025, where before it was not, and interest rates being higher for longer, I do not want to be in anything that is sensitive to either interest rates or inflation as a whole. And so that is why we close a lot of the plays. Now, number one, we closed some Microsoft call debit spreads. That has nothing to do with inflation or whatnot. It's just that we were sitting at a very nice profit, and I chose to de-risk this position because these call debit spreads, we got them low, but they were for February. So if we have a bad end of December and a kind of volatile January, I don't want to get caught holding the bag here with something that expires in February. So we closed these when Microsoft had a nice little bounce on the Thursday morning session. We closed them at pretty much at the open, right? So here's the Thursday session. We closed them right when they were around here. So not too bad. I mean, we didn't get obviously the pre-Powell prices. We did close, if you do check, we did close one of the contracts the week prior. We closed two of them the week prior for a lot better, for $3.08 when Microsoft was like $4.47. These last ones, we just took a little bit off. We closed them at $2.85. 44% ROI. I still have one contract remaining in my portfolio, which I'll show you in just a few short moments, which is pretty much these contracts right here, right? The Microsoft bull call debit spreads. We still have one little contract for February. We'll see what happens to those. I left a little bit of a runner in the event that Microsoft does recover. In terms of the other plays that we closed, well, we closed some the end phase. You remember I had the $85 calls for June for $7.65. We closed them with some remaining profit. End phase is just a stock that's going to be affected, guys, by, higher interest rates for longer, because a lot of these solar installations, they require a lot of financing purposes, right? So for that reason, guys, I closed these on the bounce that we had after on the Thursday session. I mean, you can argue that we did close it somewhat at the lows down here. We closed it here and we did bounce higher, but I just wanted to protect the gains, guys, because if this sector is going to remain out of favor, then I'm not going to play these call options. I'd rather play them with either maybe some short puts using the wheel strategy, but holding calls for the expansion, it could play out. I could be wrong, but if we go through an end of December that's volatile, early January that's volatile as well, this one may just kind of oscillate down there. And I'd rather just allocate the money to some things that are more favorable right now and a more high conviction trade. So we closed the end phase, we walked away with some profits, and then the next ones, we took a few losses, which are completely normal, right? Anything that was low conviction or a sector that is kind of out of favor right now, I just closed after Powell, guys. NVO, we tried to play the recovery bounce. 120 calls for April we had. 678 was the entry. We closed them for $4.50 after the Thursday session. NVO was actually moving nicely. We were actually up on those calls prior to Powell this day right here. And then we closed them pretty much right before the drop. Good thing for us, guys, we did not get this drop on the Friday session. We closed them on Thursday at the open pretty much. Here's the Thursday session after Powell. We were up on the calls here, but I want to hold them into the possible expansion of the daily uptrend into the 120 area. So we were like break even. We were up on them for a little bit. And then after Powell, guys, I said, you know what? That's enough for me. We're going to go into too much uncertainty with the healthcare sector into January, into the Trump administration and its policies. I'm closing. Good thing we did close down there. We would have held them for one more day, guys, and we would be down a lot on those. So good thing for us. We were able to minimize the loss here. 678 down to about 450. So it's like a $225 loss, guys. Most of the other wins, even the wheel wins, they largely make up for this loss. It was still a 34% loss, though, on a directional trade. And lastly, the Russell. I told you guys I closed the Russell leap that I had for September. I might look to reposition, guys, but in the face of uncertainty around inflation, uncertainty around the direction of interest rates, well, I'm not going to stick around to find out whether or not it's still a risk-on environment for small cap stocks. We closed this one as well, first thing on the Thursday session with the bounce for a 24% loss. So that is a case in point for trades that I was trying to make. They were swing trade attempts at sectors that were kind of teetering between favorable and unfavorable. And now that there's a lot more uncertainty, I just closed the uncertain trades. And we also had a few earnings trades on, so for some lottery plays, the 2 standard deviations from the expected move trades that I show you guys. Micron, that was a 100% win, 82.5 short puts. They ended up nicely. Micron closing around 88 for the week. And Nike, 65 puts as well. They ended up at a win as well. So that is a recap of all the trades that we've made this week. A few losses that were closed, of course. Now, the positions that I've kept, I'll show you guys that other positions after Jerome Powell on the Thursday session, I did do a lot of covering, especially for some leap calls. So AMD right here, this is a new position. I told you guys I'd be bidding, and I bid right before Jerome Powell when AMD got the hourly uptrend, guys. This was the funniest trade ever. We thought that we were getting the weekly, the daily bounce. I always tell you guys, watch for the hourly uptrend shift on the daily timeframes to know the daily lows are set and going for the bounce. We went for it, and then unfortunately it was down here. We went for it, and then Jerome Powell gave us a beautiful Christmas gift, right? So now we are down on that position, but I still like it. You see how much time I have on these. December 19th, 140 out of the money calls. They are leaps. We got them for $21.86. We also have the longer dated wheel trade right here for January the 10th, 120 puts. They are underwater right now. We got $3 in credit. Break even is going to be 117. I don't mind. They want to give me shares at 117. I will take them. Amazon, the leap call option that we have for January, we're up on that contract, but we did hedge right now. We've been hedged this one for about 2 weeks of time right now. 230 call is the hedge, which is the highs of Amazon. We got $4.74. The covered calls right now are up, protecting a little bit of downside. Now, moving on further, I opened up a brand new position in Berkshire as well. So we have the 470 versus 475 bull call debit spreads for Berkshire. We're looking to play, I told you guys, I'm looking to play this value dip. And so I chose 4 value companies, arguably the leaders of their respective industries, are very high quality names for some dip recoveries, right? Berkshire, support area, looking for the protection of the weekly uptrend into possible expansion, looking for expansion into this area right there. And we are holding these for a lot of time, guys. These are for March. So a lot of time on these. We got them on the Friday session. We got them for about $2.17, but I show you guys, I'm going small on these because I'm making an attempt at the recovery of a sector, but I'm not kidding myself in knowing that we can have more volatility. So all these plays that I took, guys, I took them extremely small. That is Berkshire. Still have the EVVTY swing shares, no secret there. Google, 135 leap call. You can see we did protect this one as well on the Thursday session. We covered it up. 195, which is arguably the highs of Google. We got $8 in credit. So the break even on these calls is 203. Even if Google goes up to 203, guys, I'm still not losing any money, right? So we got them for $8.07. They're now down, or they're now in profit, covering up the covered calls, or covering up the leaps rather, in the event the leaps have some further decline into December and January. Intel, leap call positions, asymmetric bet, still there. Coca-Cola, swing trade for the May calls, those are still there as well. I still like Coca-Cola. If we get a little bit of risk off, a risk off movement in the market back to value, could see a little bit of rally here on Coca-Cola. Just looking for the monthly uptrend recapture, and I have all the way until May to get to $65. So I still do have a lot of time. We'll see how this one goes. Moving on further down the list here, guys, KWeb, that's another trade on the recovery of the China trade as a whole. You can see we bought them just about a week ago at this point. We are down, but I gave myself a ton of time. 2 years to be exact, for China's economy to recover and boom once again. So they'll be in the portfolio for a long time. Not looking to close them anytime soon, guys. MCO is swing trade number 2 for value. Moody's Corporation, we bought them Friday. You can see we're pretty much break even right now. Why? Because it's a very nice setup right now. Monthly consolidation at the tops, looking for possibly protection of the weekly uptrend. Big drop in value the last roughly 2 weeks. Daily almost oversold for Moody's Corporation. Such a solid company. Support down here from the month of August pretty much. So we're looking for a little bit of a pop recovery on MCO. If there is a pivot from risk on to risk off in the markets, MCO should do well. This is another company that I'm bidding, but as you can see, guys, very small for position sizes for me. This one is only a $2,400 position. Moving on further, there's Microsoft I already talked about. Microsoft wheel trade for Friday coming up because of the Microsoft dip that they had this week. 430 short puts, guys, which is pretty much the end of the support zone down here, right? 430. right in the middle right here. I do not mind being assigned on Microsoft, and if I am assigned, I will be getting about $2.05 in credit. We will see if Microsoft can pull it together. If we get a bounce Monday and Tuesday, these contracts should be moving very, very nicely. Now, when we got roughly 0.5% for that trade as well, Micron, these trades are now underwater. We will be keeping these into the expansion into 2025. These just require the recovery of the overall semiconductor industry. NVIDIA talked about it. Those are our swing trades as a whole. We also have the covered calls on for next week, as I told you guys. So this is the wheel assigned position. We'll see what happens with it. Oxy holding this one into March pretty much, but it's not looking very good. SoFi, another wheel trade for next week. We got the 15 puts on the Thursday session for 50 cents as a whole. We'll see if we get assigned on SoFi, but I like SoFi. I'm willing to play it a bit up here for the momentum, but I would not be surprised if we can just roll over if the market keeps rolling over. My next DCA for SoFi will come in at the $13 to $12 range if we look to seek for more weekly higher lows before more trend expansion, but I figured I should play it with a cheeky bid. Guys, I can go a lot heavier on SoFi than this. You guys have seen me play a lot heavier than this on SoFi. So far for now, only one contract, 15 with possible DCAs down to 13 and 12. 50 cents, getting about 3.5% for the week, so I'll take it. SOXL, we also covered up these calls right here. We have the May 25 calls, recovery of semiconductors. We covered them on the Thursday session with some $30 poor man covered calls, $2.67. We are subsidizing the cost of these calls by running covered calls against them. So far, they're up a little bit in terms of profit. We'll see how that one goes as a whole. Square, same thing. We had these leap calls with a ton of profit. We closed two of them, one at $18, one at $20, and now you see they're back down to about 15. I still like Square as a whole. I still think they do have a good chance of setting up for the weekly higher lows into recovery, but if Bitcoin keeps coming down, if the risk on trade keeps getting a little bit of uncertainty vibes, we could come down a little bit more, and then only then get a rally into early February, perhaps late January, early February. I just would not be surprised at this point, which is why I'm covering a lot of my gains. We covered them with the 102 calls for end of January for about $2.32. We are going to cover a decent, well, not a lot of the gains that we have, but a little bit of gains, right? Nice little $400 for two contracts, slight little cover there as well. Lastly, we still have some TLT. The Januaries are not looking good. They're pretty much worthless, but even the Junes are not looking the best now. If I have to use TLT as a hedge again, or if I want to make a directional bet on this one, guys, these were hedges leading into October, right? Everybody was saying, well, we might go into a recession, growth is done for, inflation's coming back, and everybody was thinking that TLT could be a very good hedge. Turns out, when the Fed started cutting interest rates, the opposite effect happened, and the TLT hedge proved to be not such a good hedge at all. So this was a very small hedge in the relation to the size of my portfolio, but a hedge nevertheless, and now we are down a ton of money on TLT. I'll be the first to say it. These are losing hedges right now. If I had to make this trade again for the future, I'll be looking for December 2025 or June 2026 and going a lot closer to the money on these. And lastly, our Uber assigned position, you can see it right there with the covered call, which we are doing well on. That's pretty much almost worthless. We'll be looking to reset those covered calls next week if we get a bounce. And we also have the Uber Leap option that I showed you guys as well. Sitting down here, these 65 calls for how long, guys? A year and a half. A year and a half to get back to 65. Decent, right? So we're down, or we're actually up on those slightly. We got them from 12.11. They're trading for about 12.45 right now. And two more companies that I added, very small positions as well, guys. You can see how small these positions are, right? Because we are not fully trusting these markets, but we want to make a little bit of a recovery play on value names. UNH, one of my favorite healthcare names as a whole, coming into a decent area. And I was telling you guys, wait for the absolute flush. And now we have gotten the absolute flush. Oversold conditions. 4-hour oversold conditions. The bulls are trying. They're trying to set up the daily lows right now, trying to go for the daily trend change, trying to set the weekly bottoms. So we will give them some time to do that. They tagged the 200 weekly, huge support range for UNH. But you guys see, I can go very heavy on these positions if I wanted to. Am I going heavy right now? No. One contract, bull call debit spread 520, 530, bull call for March of 2025. So I'm just looking for a slight 5% bounce from here, acknowledging there's resistance in this area, just looking for a bounce and closing the contracts up here. Very simple trade, guys, from oversold conditions. And lastly, Waste Management as well, another decent value name with a very decent setup as well. Look, coming into big weekly support, has been crushed from the value name Destruction recently, daily oversold conditions. So I am bidding in one of the most high quality companies that the value sector has to offer as a whole. Such a high quality company, guys. And we played this one in the past here. We always got some nice pops. We'll see if we can do it again. Playing daily oversold conditions down here. We bought them on Friday. Just looking for a little bit of a bounce on these contracts. So we went with some bull call debit spreads. One contract, we paid $4.09, 409 bucks. And we got the April 210, 220. So you can see I'm putting a lot of time on these contracts, giving it some time to recover, but I am starting to bid a little bit of these value names that have dropped a lot. That is a full portfolio recap, guys. Hopefully you appreciated that. And sorry once again for the long video. It is the last of its kind. So hopefully you appreciated these videos. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these videos pretty much every Monday through Friday after the close. Hopefully I see you back in a new one. And if you have any questions, of course, please leave them down below in the comments. Anything you want. If you want a second opinion on a stock, an options play, anything you want, I'll give you my best opinion without it being financial advice. You want to discuss the macro, the trading strategies, anything you want, guys, leave it down below and I'll do my best to answer you, usually within the first 24 hours. And lastly, if you guys want access to all of these trades in real time, all of these trades since the start of the Discord, you can see we took a few losses this week. I'm always very transparent with those. Here are all the trades since the start of the Discord. You can see, right? So wheel trades, directional trades, if you want access to all of the wheel trades, the call option trades, the leap call option trades, the long-term portfolio trades as well, well, the link to the Discord is down below. We also do private morning live streams for about an hour or two every Monday to Friday. Private videos. We go over psychology, trading strategies, technical analysis, various things like that that are not on my YouTube. And we also, all the trade alerts are right here, of course. And you can talk with me all throughout the day and ask me your questions about your stocks, your options, and I will give you much more detailed answers with some charts and stuff like that. So if that's something that interests you guys, the link is down below in the description. I will be doing a Christmas promotion starting pretty much on the Monday session. So if you want to wait till that, it'll be there on the Monday session. But all in all, hope to see you in there soon. And if not, guys, well, I guess I'll see you back on the channel. So take care. That's it for me. Enjoy the rest of your weekend. I will see you tomorrow for the top 5 options plays of the week. Take care and peace.